Welcome to StockTok's deep dive into RTX Corp. RTX is one of the world's largest aerospace and defense contractors, generating revenue from military aircraft, missile systems, intelligence and space technology, and advanced electronics for government and commercial customers globally. The company operates at the intersection of national security and technological innovation, serving the U.S. Department of Defense, allied governments, and commercial aerospace partners. Over the trailing 12 months, RTX has traded in a 52-week range from $127 to $214. As of May 11, the stock is trading at $177, positioning it roughly in the middle of its recent range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. RTX generates revenue through four primary channels: advanced air vehicles, which includes fighter jets and military helicopters, missiles and fire control systems for defense, space and airborne systems, encompassing satellites and reconnaissance equipment, and intelligence and space technology. The company's competitive moat rests on several durable factors. First, it has long-term, multi-year defense contracts with the U.S. government and allies, which provide revenue visibility and switching costs that are extraordinarily high. Second, RTX owns proprietary technology and manufacturing expertise in areas like advanced propulsion and radar systems that are difficult for competitors to replicate. Third, the company has invested heavily in supply chain integration, giving it cost advantages. Our StockTok score rates RTX at 43 out of 100, signaling caution. The breakdown: valuation scores 6 out of 20, financial health 11 out of 20, profitability 7 out of 20, growth 11 out of 20, and smart money sentiment scores 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? RTX trades at a price-to-earnings ratio of 32.36 times trailing 12-month earnings. Looking forward, the next 12 months consensus estimate puts the forward price-to-earnings multiple at 25.01 times, which represents a modest contraction, but still sits above long-term historical averages for the aerospace and defense sector. The price-to-earnings-to-growth ratio, or PEG, is 1.02, suggesting the current valuation is roughly in line with the company's mid-term growth expectations. However, the enterprise value-to-EBITDA multiple of 17.20 times signals the broader capital structure is pricing in a fair amount of growth optimism, particularly given the company's size and maturity. On the price-to-sales multiple, RTX trades at 2.57 times revenue, which is moderately elevated but not extreme for a company with RTX's margin profile and contract visibility. Here is where valuation gets interesting. Our DCF model suggests the stock is trading at 0% margin of safety to intrinsic value. In other words, the market is pricing RTX at fair value with virtually no margin for error. Wall Street analysts, across 22 firms, have a consensus mean price target of $216, with targets ranging from $180 on the low end to $242 on the high end. From current levels of $177, the mean target implies approximately 22% upside. Taking both signals together, a reasonable fair value range in our view sits between $180 and $220. Regarding the latest quarterly results reported approximately 54 weeks ago, RTX beat earnings per share expectations, delivering $1.56 versus a $1.43 estimate. However, revenue came in at $22.08 billion against a consensus estimate of $21.3 billion, a beat on the headline, but the company faced a year-over-year revenue decline of 8.9%, which represents a headwind. Operating margin contracted to 10.87%, and net income of $2.06 billion suggests the company is managing cost structure amid lower volumes. Market sentiment around RTX leans bearish, driven by concerns around competitive pressures and broader defense spending outlook uncertainty. The valuation setup presents a mixed picture. Analysts see upside, but the DCF model leaves no room for disappointment. Moving to financial strength. How solid is the foundation? RTX scores an 8.0 on the Piotroski F-score, which is a 9-point financial health checklist that examines profitability, liquidity, and leverage trends. A score of 8 indicates strong financial quality and suggests the company is not showing signs of accounting deterioration or hidden leverage surprises. The Altman Z score, a bankruptcy risk model, sits at 2.60, which places RTX in the gray zone, not distressed, but not in the safe zone either. This score warrants monitoring, particularly if earnings decline accelerates or debt levels rise materially. On the debt side, RTX carries a debt-to-equity ratio of 0.59, meaning the company has roughly 59 cents of debt for every dollar of shareholder equity. This is moderate for an industrial company, but reflects RTX's substantial leverage relative to its peers. The cash-to-debt ratio of 0.18 indicates that cash on hand covers only 18% of total debt, which means the company relies on operations and credit facilities to service obligations. Interest coverage, the ratio of operating earnings to interest expense, comes in at 5.65 times. This is healthy and suggests RTX can comfortably meet its interest obligations from operating cash flow. However, the current ratio, which measures short-term liquidity, stands at 1.02, barely above the minimum threshold. This suggests RTX has limited financial flexibility for large one-time expenditures or downturns without tapping credit lines. Overall, the balance sheet is solid but not fortress-like. The company can service its debt and fund operations, but it has limited cushion for adverse scenarios. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, or return on invested capital, which sits at 5.85%. Return on invested capital measures how much profit the company generates for every dollar of capital it deploys into the business. For a capital-intensive industrial company like RTX, a return on invested capital of 5.85% is modest and suggests the company is not earning a premium return on its invested assets relative to its cost of capital. This is a concern for long-term value creation. Gross margin, the percentage of revenue remaining after direct manufacturing costs, comes in at 20.21%. This reflects the fact that defense contractors have substantial material and labor costs embedded in their products. Operating margin, which measures profits after all operating expenses, is 10.87%, indicating that roughly 11 cents of every revenue dollar converts to operating profit before interest and taxes. The net profit margin is 8.03%, meaning approximately 8 cents of every dollar of revenue flows through to the bottom line as net income available to shareholders. This is reasonable for the aerospace and defense sector, but not exceptional. Free cash flow margin, the percentage of revenue that converts to actual cash available for distribution, is 8.82%. Importantly, free cash flow margin exceeds net profit margin in this case, which suggests the company is managing working capital efficiently and is not being consumed by heavy capital expenditure requirements. However, the overall profitability profile reflects a mature, moderately profitable industrial business rather than a high-return operator. The latest quarterly results support this picture. The company maintained solid margins despite the revenue headwind, suggesting management is disciplined on cost control. On to growth. Is this business expanding and at what rate? Over the trailing 3 years, RTX has grown revenue at a 9.7% compound annual rate. Over the 5-year horizon, revenue growth comes in at 10% annually. These figures suggest RTX is a steady, mid-single-digit to low double-digit grower, which is respectable for a mature defense contractor but hardly accelerating. However, the most recent quarterly data, reported approximately 54 weeks ago, showed a year-over-year revenue decline of 8.9%, which signals a deceleration or cyclical headwind in near-term demand. This creates a tension. The 3- and 5-year trends suggest underlying growth momentum, but the latest quarter suggests that momentum may be slowing or that the company is cycling through a revenue trough. Book value growth, the annual increase in shareholder equity per share, has actually declined by 0.6% over the trailing 3 years, which is a red flag. It suggests that despite revenue and earnings growth, shareholder equity is not accumulating due to high capital deployment, share buybacks, or both. This is not uncommon for mature industrial companies, but it limits the internal capital generation story. On the dividend front, RTX yields 1.57%, which provides a modest income component to the total return profile. The dividend is sustainable given free cash flow generation, though the yield is below many peers in the sector. Overall, the growth picture is mixed. The company has grown revenues steadily over multiple years, but recent quarterly deceleration and flat book value growth suggest the company is mature and facing near-term headwinds. Now let's talk smart money. What institutional capital is actually doing with this name? RTX is held by 20 top-tier institutional investors, the biggest pension funds, endowments, and hedge funds that are scrutinized by the financial community. The largest holders include Dodge and Cox funds, which allocates 3.72% of its portfolio to RTX, but has been trimming the position, reducing holdings by 6.3% recently. Lee Ainsley at Maverick Capital holds 2.7% of his portfolio in RTX and has actually been adding slightly, accumulating an additional 0.68%. David Tepper at Appaloosa Management holds 1.34%, but has also been reducing exposure by 1.86%. Robert Alstein at Alstein Capital Management holds a smaller 0.48% allocation, but has made a significant reduction of 28.13%, signaling skepticism. Thomas Gaynor at Markle Group holds 0.36% with no recent change. Looking at 13F filings, which are the official quarterly disclosures of institutional holdings, 17.6% of major institutional filers are net buyers of RTX, meaning they own more than 50% of shares held. This is a neutral to slightly positive signal, but not strong conviction. More concerning is insider activity. RTX insiders own only 0.34% of shares outstanding, which is very low and suggests management has minimal skin in the game. Over the last 3 months, insiders have executed 0 purchases but 7 sales, which sends a warning signal. When insiders are consistently selling while institutional money is mixed, it often reflects skepticism about near-term valuation or confidence. The smart money picture here is cautious. Major investors hold the stock but are trimming positions, and insiders are net sellers. And finally, the verdict. Let's bring it all together. On valuation, RTX trades at fair value with virtually 0 margin of safety, and while Wall Street sees roughly 22% upside to a $216 mean target, the DCF model leaves no room for disappointment. On financial strength, the balance sheet is solid but not fortress-like. The company can service debt and fund operations, but has limited cushion. On profitability, the business is moderately profitable with a 5.85% return on invested capital that is below the cost of capital, which raises questions about long-term value creation. On growth, RTX has delivered steady mid-single-digit to low double-digit revenue growth over 3 and 5 years, but the latest quarter showed an 8.9% year-over-year revenue decline, signaling near-term deceleration. On smart money, top-tier institutions hold the stock but are trimming positions, and insiders are net sellers, not a strong signal of confidence. In our view, a fair value range for RTX sits between $180 and $220, representing approximately 0% to 24% upside from current levels. The latest quarterly results, while beating earnings estimates, confirm that revenue faces cyclical headwinds, which reinforces caution around the thesis. The core challenge with RTX is that the company is priced fairly but offers limited margin of safety, faces near-term revenue headwinds, and generates returns barely above its cost of capital. This setup is suitable for long-term, patient capital comfortable with mid-single-digit returns, but it is not attractive for those seeking margin of safety or above-average growth. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on RTX Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.